Hello there. Thank you for joining us today. I'm Marcia Butler, the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you this educational presentation today. Attendees are muted, but we do encourage you to ask questions using the chat box. The presenter will answer these queries during or after the webinar today as appropriate. If you ask a question and we're not able to get to it during the webinar today, go ahead and leave your contact information as well. If we can't get to your question, we'll go ahead and reach out to you after today's webinar. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our presenter today. Ethan T. Brown has a bachelor's degree in political science from the University of Michigan and an MBA from the University of Massachusetts at Lowell. He joined Cox Capital in 2015 and became a partner in 2020. His primary responsibilities include equity and fixed income research, portfolio management, and meeting with clients. He holds the CFA and CFP designations. Ethan is a former national champion triathlete and an Olympics trials qualifier. In addition to his role at Cox Capital, he sits on the board of directors for the Drake Academy of Excellence. Ethan, we're excited to have you here, and I'm going to go ahead and turn over the time to you.
All right. Well, thank you so much, Marcia. And thank you to Advice Chaser for having me back. I think this is the 5th or 6th webinar I've done with Advice Chaser. So we've covered a range of topics, but today we're talking about what to expect in 2023, and we'll do a kind of a review of the main headlines that drove the markets in 2022. Before I get started, I'll just kind of reiterate Marcia's comments that nothing I say should be construed as an investment advice. Any financial decision needs to be made in your own personal context. So if you need help, please reach out to an advisor. At any rate, I think we have a nice presentation for you today. So we'll go over the main drivers of the markets in 2022, what made things go up and what made things go down, mostly down, unfortunately. I'll kind of give a summary of how different asset classes performed. And then I'll try to kind of paint a picture of where things stand today and what we're likely to expect in the year ahead. So I think there'll be a variety of things that'll be much different than the year we had in 2022. So first thing we have here, inflation. And if you haven't heard the word inflation over the past year, you've been living under a rock, because it's basically the buzzword in financial media. As a financial professional, I hear it like 100 times a day. I'm kind of sick of it, but it's probably not going anywhere. So I've got to get used to it. And essentially the 20-second overview is that when the COVID broke out, the pandemic hit, we're all quarantined at home. The government injected a ton of stimulus into the economy. They gave people added unemployment benefits. They checks basically to stay home. So there was a surge in savings, and people were bored at home. They couldn't go out and spend money, so they shopped online. So people ordered a ton of stuff. And so this was happening right at a time when borders were shutting down across the world. So you had supply chains in disarray. Everything we needed in China to send to Europe to finish a product in the US, was not able to be complete. So you had a complete surge in demand kind of fueled by the stimulus, a complete breakdown in the supply chain. And so if you've got a ton of demand and small supply, prices have to go up. So that's essentially what happened. And it didn't really end once the restrictions started to lift, because you saw this surge in demand kind of shift to other areas in the economy. People hadn't been able to go out and travel, go to restaurants, so they did these things even more so than they did before the pandemic. So that highlighted kind of a shortage in the labor force. There just weren't enough workers out of there. And so essentially the demand outstripped all the supply in many different areas, and that's why for, the past 40 years, we have not had to deal with inflation, but it's certainly back. Yeah, we have a nice chart here. So this goes back to the early 80s, and you can kind of see that things have trended downward since that time frame. And then, just after 2020, it shot upward. So the good news is it does look like it has peaked. If you look on this graph and you see things coming down, that's a good sign. The bad news is that it's still much too high, and there's probably going to be more pain ahead in order to get it under control. And speaking of getting it under the control, the Fed are the people that are supposed to do it. The Fed has two mandates. Their job is to keep inflation low, and keep unemployment low. The problem is a lot of times they can't do both of those at the same time. And so in response to inflation being really, really high, they have had to aggressively raise interest rates. And I think we have a chart of that as well. And you can see in this chart that we'll show, this has been the quickest tightening cycle probably since the early 1990s. The first kind of bump on this chart is in the early 2000s, from about 2004 to 2006 or 7. The Fed had to raise interest rates about 4%, and it was over a period of about 2.5 years. Well, we've basically raised rates 4% in less than a year. So the pace of these rate hikes are really far outstripping anything we've seen in a generation. And so the reason that the Fed is raising interest rates is because they need to slow down demand. And if rates are higher, then mortgage rates are going to go up. So less people will be buying homes, less people will be applying for auto loans. People won't have access to credit. That should slow down the economy enough, hopefully in the Fed's eyes, to allow the supply chains to normalize, supply chains to restock, and that should hopefully bring down inflation. At least that's the rationale. There's lots of different debates on whether or not that will work and what implications it'll have in the long term. But certainly higher rates, they ultimately make equities less attractive, because if you can get a guaranteed 4 or 5% on a risk-free treasury, it makes the appeal of stocks a little bit less if you can get a decent risk-free return. So the Fed's embarking on this tightening path. It's having really big implications in markets and the real economy. And, we might be going into a recession because of that, which we'll talk a little more about. So beyond the basic, supply and demand, things that are going on, you have some of these exacerbating factors. So first off, the war in Ukraine. Ukraine is one of the biggest exporters of wheat. Russia is one of the biggest exporters of oil and gas. So if these two countries going to war with each other has created supply or turmoil in those supply chains as well. Wheat, oil, and gas are inputs in a big portion of the goods out there. So the fact that we can't get these things is keeping inflation high. The other thing that this whole post-COVID world has highlighted is that we have a shortage of energy. For basically 10 or so years before the pandemic, the returns for oil companies were pretty poor. You had some disinflationary factors going on. And so as a result of that, a lot of oil companies stopped investing in new production. And so what that did is that when you have a surge in demand, like we've seen over the past couple of years, you've seen energy prices skyrocket just because we don't have the supply coming online that we need. And unfortunately, green energy and kind of more environmentally friendly sources of energy, we're still a long way away from building that infrastructure up so that that can be a reliable and consistent source of energy, so we can kind of stop depending so much on kind of greenhouse gas emitting fuel sources. So that's the goal, but we're still a long way from there. Then the final bullet point here, and this is starting to reverse a little bit, would be the zero COVID policy in China. So when you have a whole country essentially shutting down, you have supply chains that you desperately need to get goods out of China, and if they shut down a plant, there's really nothing you can do. So that just further throws supply chains into disarray, affects the supply side of the equation, and so that's what we're dealing with now. Although hopefully China's kind of doing a 180 on that policy, and so that will hopefully become a tailwind as we go forward. But all these factors are keeping inflation high. And so what effect has that had on the market? It's been pretty disastrous. Looking back in the history of markets, there's not many years when you find both stocks and bonds down double digits. I think you'd have to go back to the 1930s to find a year when it was that bad. So unfortunately, one of the most widely followed bond indexes, the Barclays Aggregate Bond Index, down 13% for the year. International stocks did a tad worse. S&P 500 down a little under 20%. Officially a bear market is when a stock index is down more than 20%. But there were certainly times throughout the year when the S&P was down more than 20. I think at its peak, probably in early October, or at its trough, I should say, was down about 25%. Tech stocks have gotten disproportionately hit in this market. Higher interest rates tend to cause more pain in growth stocks. And why that is a little complicated, but essentially, if a stock does not generate earnings, say it's growing quickly, but it's not supposed to have profits 5 years or 10 years down the road, in a zero interest rate environment, if you're using a discount rate on that cash flow of 1 or 2%, which is what the interest rates were, it will result in a much higher value. If you bump that interest rate up from 2 to 4%, the discounted cash flow equation comes down significantly. And so that's why you've seen some of these tech stocks that were big beneficiaries of the pandemic really come back down to earth this year. The NASDAQ almost down a third. And then finally, the crypto index down 70%. I think what this bout of inflation and raising interest rates have done is really take a lot of these speculative areas out of the market. And so much of the cryptocurrencies out there were very speculative, borderline pyramid schemes. There are some legit currencies out there, but when you had tech stocks falling, the stock market falling, the area that's kind of most speculative typically gets hit the most, and that's why you've seen kind of the damage done in the crypto world, which it is ultimately, I think, is a good thing, because it's going to get some of the fakers out of the market, and you'll see who survives, and that'll say something. But no matter where you look, it's been a tough year in 2022.
We had a question here, and I'm going to go ahead and maybe summarize it because it is a long question. But do you think that the focus on green energy as opposed to fossil fuel energy has exacerbated inflation? So can you talk a little bit about that?
Yeah, I mean, in the short term, yes, it absolutely has. Is by kind of outlawing some forms of energy or incentivizing oil companies not to produce more. It's hurt supply and one of the biggest inputs in the world for anything. And so that has been inflationary. And again, I think there's no doubt that we have to decrease our reliance on harmful fuels to the environment, but we're still a long way away from building out the green infrastructure to get there and to stop producing so much oil and gas. So yeah, the answer is in the short run, I do think it has been inflationary to have that green trend. Excuse me. Right, so when we look forward about what do we expect, there's a chart that I really like. It's put out by a group called the Conference Board, and they have a really good track record of predicting recessionary times in the US and in other parts of the world. But essentially what you're looking at is, this line is a weighted average of about 10 different forward-looking data points. And when this average, or this weighted average, starts to kind of roll over and go down, you see if it goes down more than 3 months in a row, it signals a turning point in the economy. And so this goes back to about 1998, 25 years. The red bands on this chart represent a recession. And so before each of these recessions, you can see that the indicators were kind of in free fall for, about a year beforehand. And the only exception would be kind of the COVID period in 2020 that wasn't a traditional economic recession. COVID came out of nowhere. So it was almost like we were in a recession overnight. But now, you look at where we are, these indicators had peaked in early 2022. I think we're going on 9 or 10 successive months of these falling. Excuse me. So I think it's safe, not safe, but it's reasonable to think that we could be headed towards a recession. And what kind of things are in these 10 weighted average data points? You have things like housing starts. So if a builder goes to the municipal office to get a permit to build a house, that's going to be indicative of future economic activity, because they're going to need to hire workers, buy materials, and so forth. So when you have indicators like that start to fall off, it's a pretty good indicator that you're going to see some slower economic activity down the road. And so when we look at where we are right now in terms of the current environment, I'll just run through 4 different data points, but the first one would be consumer confidence. Consumer confidence is not good. When you have inflation where it is, people are worried about the future. And right now, the consumer confidence index, it's about at the depths that it was during the financial crisis back in 2008, 2009. And so, if you're not confident about the future, you're probably not going to go out and spend money. You're not going to go hire more workers. You might not go on that vacation. So it's a bad sign when consumers get fearful about what's to come. And this clearly shows that people are pretty fearful right now. Another data point would be U.S. retail sales. And this has proven to be pretty resilient. You can see the long-term average here tends to be around 5% or so. I know we're right now, I believe that last data point is at 6.5%. You can kind of see the trough during the pandemic in 2020 when it went sharply negative, followed by the rebound when it's sharply positive. But where we are today, is really not indicative of a really hurting economy. People are still going out, still spending money. This might be trending lower, but retail sales in the U.S. consumer has been a pretty resilient group. And so that would be a sign that things aren't quite as bad as they seem. But the other thing to note about U.S. retail sales is that it's a lagging indicator. So this means it's describing data that's already happened. So those leading indicators are pointing things are rolling over. Retail sales, a lagging indicator, still in a pretty healthy level, but we can probably expect that to come down in the months ahead. And then the unemployment rate, and this has been the biggest source of strength in the economy, because unemployment is still at a historic low. Despite the inflation and everything that we're dealing with, unemployment is still at about 3.5%. And just looking on this data set going back 20 years, we're still near the very, very low point of that. You kind of see the spike during COVID, but it came right back down, and it's at an extremely healthy level. And so the Fed has said repeatedly that in order for them to get inflation under control, that the unemployment rate is going to have to come up. They need more slack in the labor force, but that's going to be really difficult to do because job openings are still really high, and it's believed that we have a structural labor shortage in this country. So that may be keeping unemployment extremely resiliently low. So that's going to make the Fed job even harder if they think that they need employment to come up in order to tame inflation. But I'll say another interesting data point. I think Goldman Sachs put this out a few years ago. When the unemployment rate starts to go up, if it goes up more than, I believe it's 0.5%, either 0.5 or 0.75%, historically it always keeps going. So in the Fed's perfect world, they would like employment to come up a little bit, just enough to get the inflation out of the economy, and then they can stop raising rates and everything can be great again. But what happens historically is that once it starts going up, people get scared. Employers really pull back on hiring. They look at trying to cut costs out of their workforce. And so it typically goes up much more than what the Fed would like. 1% or so, it typically goes up 2 or more percent. So this still looks really good, but again, the next few months are going to be really telling about where the employment trends for 2023. Going forward, when we look at, based on everything that happened in 2022, what do we expect for 2023? There's always a wide variety of outcomes from all the kind of market folks who are putting out forecasts and everything like that. But I'll kind of tell you where consensus view is and kind of add some of my own input into that. So first off, excuse me, there's an article in the Wall Street Journal recently looked at, I think, 27 of the big banks out there that make economic forecasts. And so the average S&P return forecast is about 5%. So fairly moderate year, but the path to get there is supposed to be extremely choppy. And I think right now the consensus would say that we find new lows on the S&P in like the first half of the year. So the market is very volatile, maybe goes down a bit, but then by the end of the year, it's expected that the Fed will have gotten inflation under control. We can start looking ahead, maybe looking beyond an impending recession, and that things will start to rebound going into 2024. These forecasts are never right. I mean, just going back, and when you look at these forecasts to what actually happened, I mean, I don't think anybody in 2022 would have predicted the S&P would be down 18%. It just wasn't even on the radar out there. So you have to take these forecasts with a grain of salt. And I'll also just give one tip too. Whenever you hear a financial person say they expect things to be volatile, that's really code for they have no idea what's going to happen. And so this is, you turn on CNBC, you're going to see lots of people saying, well, I think the market will be volatile. I'm sure it will, but I don't know, is it going to be volatile and go up, volatile and go down? Who knows? I tend to agree with the forecast that things are going to get a little bit worse. But by the end of the year, I do think that we will have a good handle on inflation. This is my personal opinion, but I think that by the end of the year, people should be a little bit more confident relative to where they are right now. If we do go into a recession in the next 6 months or so, it's expected by many economists to be a fairly shallow type of recession. And so hopefully by the end of 2023, we'll be able to start to discount good times ahead. And then just one final note on this is that the stock market is different from your economic cycle. So you have a stock market cycle and economic cycle. The stock market tends to be more forward looking. So it tries to discount maybe 6 to 9 months ahead, maybe even more. Whereas the economy kind of lags that cycle, so people can get fooled with this because they think, well, why would I want to own stocks if we're going into a recession? Well, by the time we get into the recession and things get really bad, on Main Street per se, the stock market's probably going to be expecting stimulus from the government, a recovery in the following year. So you'll see prices start to go up in anticipation of that. And it's really, really hard to predict. Timing the market is something that's incredibly difficult to do. At my firm, we don't recommend it. If you have a really strong view on something, we say just make an incremental change. Don't do anything that's going to really affect your long-term return in a potentially negative way. So it's impossible to predict, but hopefully all this, markets going down, this volatility we're experiencing should be getting towards the end by the end of 2023. But at the end of the day, your guess is as good as mine. Yeah, so I showed that chart of leading indicators, and that's very predictive that we are headed for a recessionary period. Of those 27 financial institutions I mentioned, 23 do expect us to have a recession at some point this year, or at the beginning of 2024. Again, most economists think that if we do have a recession, it will be fairly mild. That's another hard to predict. It's another hard prediction to make, because there's typically, when markets go down and employment goes up, things get scary, things break in the financial markets sometimes. So you really don't know how difficult a time can be until we get there. But at least right now, that's the consensus forecast for a mild to shallow recession. And along those lines, as the economy gets worse again, I think you always want to stay invested long term for the most part, and the market will be discounting good times ahead, even when things seem really, really scary on Main Street and employment's going up. So it's really tough to predict. And one final note, so of the banks that did not say that we're going to have a recession, so there were 4 that said, we're going to avoid recession. Of those banks, those banks still thought that stocks would not do particularly well in 2023. They still mentioned that they thought bonds would be a better asset class relative to stocks over the near term. So that's just very interesting that we may avoid a recession, but those banks still favored going into bonds. And speaking of bonds, fixed income, I believe, is set up to do very, very well. And this is a pretty consensus view at this point. But there is a lot of historical data to kind of support this view. And I have a chart on here that we'll walk through why. But for 2022, stocks really did not have that balancing effect with bonds. Bonds are supposed to be that reliable source in the portfolio. When stocks are going down, bonds are going up, kind of offsetting your losses, giving you more diversification. That didn't happen in 2022 because rates were coming off such a low level. As rates go up, it hurts bond prices, they go down. But now, given where we are, we're near the end of this rate hiking cycle, hopefully. And so I think bonds are set up to do really well. And this is a chart that Fidelity Investments compiled the data for. And it goes back and looks at every single Fed tightening cycle going back to the 1970s. And in each of these boxes here, you've got 3 bars, this gray bar, which represents the return of bonds as the Fed is raising rates. So most of the time when the Fed raises rates, bond returns are negative. And if this should be true, if you look through all these time periods, most of the time that gray bar is negative as the Fed is raising rates. The blue bar would be the return of bonds 1 year after the Fed stops raising rates. So given that we're getting the end of this hiking cycle, when you go back and look at every single period on this chart, those blue bars have been positive, signaling that when the Fed eventually does stop raising rates, it allows bond prices to start to go up. And certainly because the Fed typically raises rates into a recession and then has to reverse. As economic activity goes down in a recession, rates come down, and that sends bond prices higher. So given where we are and the tough year bonds had, I would expect that they would be able to be a fairly good hedge going into 2023. I think that if we do have a recession, bonds probably will be positive. And I think if the Fed stops raising rates, they should almost certainly be positive. And there's a lot of data kind of supporting that view. A lot of people thought that is diversification over, having the year that we had when both stocks and bonds were down double digits. But I think it was a tough period, but fixed income is set up to do really, really well going forward. And so just kind of summarizing everything here, again, to have stocks and bonds down double digits, that's the first time that's happened in about 100 years, to just put into context of how tough a year it was in the markets. It was tough because people that think that they have conservative portfolios that are really heavy in fixed income found out that they weren't so conservative. But that shouldn't be a reason to kind of abandon your approach or your strategy, because I think a lot of that negative fixed income performance can have the potential to reverse, especially if things get worse and we do have a recession. I think bonds will be a decent hedge for that. And on a recession, all the indicators that you can think of, the consumer confidence, leading economic indicators, the yield curve, all these things are signaling that we are having a recession, or at least we're headed there. You look in the Wall Street Journal or any newspaper and you see, Facebook laying off people. The big one recently was Amazon laying off 20,000 corporate jobs, Salesforce cutting 10,000 workers. There's no shortage of headlines out there to make you scared at night, basically, because there's a lot of negativity going on out there. On the bright side, if you go back and look at what happens in years after a recession, the recoveries are typically very, very strong. So looking beyond a potential recession, that the good news is that you can expect typically financial markets will rebound fairly sharply after that. So don't the big mistake people make is bailing out of the market at the worst possible moment. And that's why, buy and hold strategies have done so well relative to folks trying to time the market, because it's so tough to not get your emotions involved and make a mistake, as opposed to just buy, hold, have your asset allocation target, and just, don't look at the account if things aren't going well, because you'll be better off, 5 and 10 years down the road. And one thing that we tell our clients is that, when we build a financial plan for somebody, we try to bake in some turbulent scenarios, say, okay, what happens if we get that 20% correction in the market, and show people that you can withstand a bad period if you just kind of focus on the long term.
All right, well, we have some time for questions, and I will remind people you can go ahead and put your questions in the chat while we're doing this. So can you talk a little bit about how the Fed raising interest rates, what that interest rate is for, and how that affects the general market?
Yeah, that's a good question. So when the Fed raises rates and it's at 4 3/4, so what they're doing is they're raising the overnight rate that they lend to banks. And so what this does is it incentivizes the banks not to loan out any money that they can't get better than that 4 3/4 on. Because if they can deposit their money with the Fed and get that guaranteed 4.75% overnight rate return, then that, and not take on any risk, that's a pretty strong incentive to do so. So in turn, in order for the banks to make you loans and be compensated on that loan, they're not going to offer you a mortgage at 3% when they can get a guaranteed 4% from the government. They're going to say, well, you got to pay us 6 or 7%. And so that Fed rate basically trickles throughout the economy, and it sets the base for mortgage rates, for any sort of risky consumer debt, for auto loans, loans. And so, with those rates going up, it makes financial conditions a lot more tight in the country. It makes it harder to get approved for a loan. And what it also does is, because the banks employ economists to kind of make forecasts, if they think the economy is slowing, they're going to make their underwriting standards even tighter. So if you have decent credit and maybe in a really booming economy, you'll get a loan. Well, maybe that changes as the Fed raise rates and the banks kind of tighten their belts. But that's a really good question. But it is it's the rate that the Fed lends money to banks at the end of the day.
Thank you. Can you talk about why economists think it's going to be a shallow recession, or predict that it may be a shallow recession?
Yeah, sure. Yeah, so I think that the reason for the shallow recession forecast is essentially that the American consumer is in like a lot better shape, like relative to like a 2008. Like, people aren't super over leveraged on like their credit cards. They didn't take on mortgages that they couldn't afford to pay. So there's in general a lot less leverage out there in the economy. So less leverage means there's less debt for people to default on. Then I think with unemployment being so resilient, and with kind of a structural shortage of workers in this country, it will always keep a decently strong demand. People will be able to find a job if they really want to. May not be the job that they want, but those are the reasons, I think, is that people, their savings are in a better spot. They don't have as much personal debt, and there's still a ton of job openings out there. So all that taken together, I think, translates into not a financial crisis type of scenario.
I have another question that relates to employment. So this is a good question. With the major layoffs in large tech companies, while the overall job market is still strong, does that indicate that perhaps there are layoffs in the high paid, high tech jobs, but the remainder of the jobs in other industries and service sector that perhaps don't pay as much for now remain relatively strong?
Yes. Yeah, no, that's exactly what that means. I mean, there was probably, kind of call it, too much fluff in the tech industry before this. Because I mean, if you were a software developer and you were in Silicon Valley making like $400,000 a year, you could literally look for a job and find one next week for 800. Like, you'd get double the salary. It was crazy. And a lot of that compensation would probably be tied to the company's stock. Well, now that the stocks are not doing great, they're not able to be as competitive, and their bottom lines are getting squeezed. So they're kind of cutting out all those high paying jobs that they gave to people that, when it comes down to it, probably shouldn't have given out. But that's exactly right, because this was a big headline with not the latest employment report, but the previous one from December, is that a lot of the jobs that were being created are kind of like lower level service sector type of jobs, not lower level, but just lower paying. And a lot of we weren't hiring as many kind of high tech, high paying jobs as before. So yeah, there may be kind of a reshuffling going on out there, where the job market's still strong, but it's not the jobs that are paying $500,000 a year. It's kind of more wage labor and service industry oriented work. But that is definitely a dynamic that's at play. And good question.
Yeah, it's a really good question. So you talked about lagging indicator being one of the factors you talked about. Can you talk a little bit about what leading and what lagging indicators are, and maybe an example of those kind of things?
Sure. Yeah, so a leading indicator would be predictive of future activity. So there's an organization called the ISM, the Institute for Supply Management, and every month they take a survey from all the different manufacturing companies that they work with of new orders. So they publish this data, and it's reasonable to think that a leading indicator is, if a company is getting a ton of new orders, then they're going to have to maybe go out, hire more workers. They're going to be running more shifts in their plant. and they'll be buying more raw materials. So it should be predictive of work, 3 to 6 months down the road. So that's a leading indicator. And a lagging indicator would even be like the employment rate, because we're looking at a period that's already happened essentially. So, we know that last month the unemployment rate was 3.5%, but that's not really telling us much about where employment is going to go. So it's really in the rear view mirror. So that's more of a lagging effect. For employment, every Thursday they publish the new claims for unemployment. And this is actually a leading economic indicator, because if more and more people are applying for unemployment, then more people probably got laid off. And so that's less spending that those people will do, less consuming that those people will do. And so that's going to have a slowing effect on the economy. So hopefully that's helpful.
Yeah, and then we have time for a couple more questions here. Are there certain sectors of the economy that tend to remain stronger in this type of recessionary environment? And
Absolutely.
yeah, they put a couple in here as examples, but I'll let you speak to that.
Sure. Yeah, so you typically, on a really broad level, you could break up all the sectors out there into cyclical versus non-cyclical. And so when you really think about, I'll just take some non-cyclical defensive sectors, would be like healthcare, utilities, consumer staples. So these are sectors that even if we go into a recession, you're still going to go to the doctor if you get sick. You're still going to pay your electric bill. You're going to go to the grocery store and buy food. So these sectors should theoretically be a lot less dependent on economic growth to thrive. They should be more kind of like viewed as essential purchases that need to be made regardless of the economic condition out there. You contrast that with like, an airline or a car company, a cruise line. These are cyclical companies that when the economy is booming and people have extra cash, they want to go on a vacation, they want to buy a new car. So their fortunes tend to be strongly tied to the direction of GDP. And so as you have GDP slowing, you're going to see a lot of the cyclical companies like an Amazon, start to really slow as well. Same with even a Google or Facebook that relies on online advertising. If economies are slowing down, there's going to be less people with more dollars to spend on advertising. So those, even the big tech companies are somewhat cyclical as well. So it's really, you break it down into thinking about like the things you spend money on. What are those essential items? And those are typically the companies that are going to hold up in a recession versus the more discretionary type goods. Those are going to be a lot more cyclical.
All right, and then we have time for about one more question. What would indicate that we are headed for a recovery?
Yeah, that's a good question. I think that you'd start to see maybe some stimulus from the government. I think, well, a couple of things. I think if the Fed started to cut rates, that would ease financial conditions and that would lower interest rates. And so that would spur the economy in one sense. All those kind of leading indicators that I was showing earlier, those would probably point to better times ahead. You might have consumer confidence start to rebound as, maybe prices come down. So things are more affordable and people start making investments that they had put off and now prices are more attractive or something like that. You'd see kind of new orders start to rise. You'd see the new claims for unemployment start to come down. But then again, I think it really goes back to these past few years have shown how big of an impact government stimulus can really make on the economy. So you had things really boom in 2020 and 2021 when you had added unemployment benefits like the Paycheck Protection Program going on out there. And then as the Fed has taken all that away, then it's really become a lot harder for the economy to grow. So I think essentially if we've gotten to a recession and things were bad, you'd probably see action from Congress as well. there might be, special provisions to try to stimulate the economy. So I think if you have government intervention, if you have improving sentiment, and you have some recovery in some of those leading indicators, I think that would be a good kind of trifecta to think that we're on a path to recovery.
We want to thank everyone for their questions. If we were not able to get to your question, I do want to say you're welcome to leave it still in the chat, and then also leave your contact information. We're happy to reach out to you. I want to thank Ethan so much for being here and for the organizations that have made this webinar possible today. Thank you so much for attending. Look for an email soon with a link to the replay of this event. And you're welcome to share that replay with your friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.